There have only been a few weeks this year when the weekly home sales pace came in below last year's. The storms at the end of January, the start of the war in March, and now as mortgage rates have hit their highs for the year with the war re-escalating. This week, the pending home sales count dipped below last year's count by 0.9%. Fundamentally, it's inflation fears that are driving interest rates. The yield on the 10-year Treasury is at the highest levels in a year and a half. We got some encouraging news on the CPI data for June, which helped interest rates recede a little bit after last Monday, but the war is re-escalating. Oil prices have jumped again. These are not the conditions where interest rates are poised to fall dramatically. So when do we see the impact in the housing data? Well, since April, the pending home sales numbers have been consistently up compared to last year, but that's flipped negative now. Home prices are much slower to react. Prices are slower to react to short-term shifts in demand. Home prices have been under pressure really since last October and are basically unchanged for the year. In recent weeks, the different measures of home prices are not really getting any worse. In fact, a few of the June sales measures actually ticked up from the recent trends in home prices. So I've documented how home buyer demand in the second quarter was really better than it's been since 2022. And there's some evidence that prices responded a little bit in that window also. The time it takes to sell a home compressed in the quarter too. So days on market is only 3% more than last year now. That's down from like 15 or 20% longer at the start of the year. So that's where we are right now in the housing market. We're coming off the best second quarter in 4 years, but mortgage rates are at their highs for the year, and the third quarter is starting under a little pressure. I'm Mike Simonson. I do these videos each week so you can stay on top of the latest data in the housing market. So let's take a look at the details for mid-July 2026. This week we counted 79,000 newly pending home sales across single-family condos and townhomes around the country. That was just under 1% fewer than the same week in 2025. In recent weeks, sales have been coming in 3 to 5% better than last year, so this is the first negative print in a while. In this chart, I'm showing the 4-week rolling average here, which is 81,000 home sales per week on average over the last month. The blue line is still above last year's purple line, but that gain could evaporate quickly. In this view at the right side of the chart, you can see how the second half of 2025 was significantly better than the second half of 22. I included 22 in gray here because that was when the market had the big shock. So the second half of 25 had gradually falling interest rates and gradually improving sales that whole time. The 2022 illustrates what can happen to the pace of sales if rates are rising in the second half of the year. So the wrap up for the weekly pending sales numbers. This week came in 0.9% below last year. The recent average is now only 1.4% ahead of last year, but year to date, we're still counting nearly 4% more total sales with the weekly pending numbers than we had in 2025. So we're going to see what the rest of the year has in store for us. Does our sales count evaporate in the second half of the year? That growth? I don't know. Stay tuned for that. To get a more complete view, I tracked 3 high-frequency housing indicators. So 3 independent sources. These independent data sources, they ebb and flow together, though, and you can see in the data, they measure mortgage demand, and 2 of them measure mortgage demand, and 1 is our weekly pending contract sales count. After the war news slowed the housing market in March, I shared this data and showed how in April they all jumped at the same time. You can see that right in the middle of the chart here. The stock market had jumped to all-time highs. The biggest fears from the start of the war had subsided a bit, and our spring housing market was actually spared the worst of the scenario. More people were buying homes. This week, the signal from these 3 indicators flipped negative. So as of this week, all 3 have dipped below last year's pace. The MBA Purchase Applications Index is a survey of lenders. The Zactus number here is measuring the credit pulls. So when you apply for a mortgage, you get a credit check, and Zactus is the company doing these checks. So the Zactus number actually includes purchases and refinances. So notice how the purple line from Zactus has actually been negative for a couple months. This is likely because refis are not helped by a wealth effect of roaring stock markets. So I think this illustrates the differences, the two different housing demand forces right now. Mortgage rates are at their high of the year, but that's competing with a wealth effect from stock markets and business profitability. And that's why mortgage applications for purchase have been staying mostly above last year. But when you include refinances, there are fewer than last year. The third number here is the weekly pending count. So I use the Altos measure. As I mentioned, this count dipped below last year just now also. You can see how they move together, though. Notice how all three showed that demand break in March when the war started. Then there was a recovery for the second quarter. When the lines in this chart are in the gray shaded area, that's when homebuyer demand is measuring less than a year ago. All three are currently below the line. That's new. Over the last year, as mortgage rates gradually declined, the pace of the inventory growth also declined. My rule of thumb is when rates fall, inventory falls. That's what we witnessed over the last 12 months. Now, inventory is unchanged from last year. There are 1.09 million homes on the market across the country. That's including single-family condos, townhomes. Inventory climbed by 1.7% during the week, which is a very normal pace for mid-July. The new listings came in at 90,000 for the week. This was a touch more than last year at this time. Not a lot of sellers, still, far fewer each week than we had in the old days. So there's not a lot of supply coming. In this view, I have 8 years of that inventory data with 1.09 million listings right now. There's still fewer than the old normal days, the peak of the summer in the last decade. There are 10% fewer homes available now across the country than in 2019. There are 15% fewer than in 2017. So even after 4 years, so much of the country still has a real severe shortage of homes on the market. Our forecasts now expect about 3% inventory gains for the year, so a little bit inching higher. If we get lucky and mortgage rates fall, that'll help sales, that'll help affordability, so inventory will fall also. And these estimates would be revised lower. But as of now, we expect inventory to not really grow much for the year. Inventory is now not falling further either. The median price for newly pending home sales across the country now is just over $400,000 for single-family homes. That's a fraction of a percent above last year's prices, just a fraction higher. Pretty much all the sales price indicators from NAR or Case-Shiller or the other home price indices, HPIs, these are all reporting home prices just barely above last year. Asking prices, on the other hand, are lower than last year. The median list price for homes in the U.S. is now just under $450,000, which is 2% lower than last year. Prices are in the normal seasonal decline pattern for the second half of the year. So from my perspective, home prices have actually hit a bit of a plateau. The supply-demand balance kept home prices from appreciating this year. The most optimistic of all those price measures are really only showing about a 1% gain from 2025. But most of these have been hovering at the same level for several months. Home prices don't appear to be falling further. The risk to home prices would be if mortgage rates jumped back over 7%. You can see that part of that potential here in this price reductions data. So the percentage of homes on the market that have taken a price cut jumped this week to over 40%. Jumps like this they coincide with jumps in mortgage rates. That's pretty common. So in this chart, you can see the yellow line from 2023. It jumped in September of that year. At that moment, that's when rates climbed over 7% and headed to 8%. So this data illustrates how buyers react abruptly. So when the cost of a mortgage jumps, many buyers put a decision on hold. Suddenly, a listing doesn't get offers over the weekend, and by Monday, they do a price cut. So we can see those demand shifts in this data very quickly. And that's why we're watching this right now. Most of this year's demand has been better than last year. The blue line has been below that purple line for most of the year. Not great, but better than a year ago. With any luck, this current spike in mortgage rates is temporary, and the home buyers get the benefit of improved affordability in the second half of the year. That's never guaranteed, of course, so stay tuned for the latest data each week. All right, that's all the data we have time for today. Thanks, everybody.